Section 24 trap. What landlords need to know. The hidden cost, £15,000 average extra tax per year paid by UK landlords due to Section 24 mortgage interest relief restrictions, and it compounds every year you delay acting. What is Section 24? Phased out between 2017 and 2020, landlords can no longer deduct full mortgage interest from rental income before calculating tax. There's 20% basic rate credit only, so full deduction is replaced with a 20% credit, so higher rate taxpayers face a significant tax increase. And this applies every year, whether you own one property or a portfolio. Section 24 affects your bottom line annually. Section 24 has silently eroded landlord profits since 2017. Many landlords are paying thousands more in tax without realising why. So the Section 24 phase-out timeline, in 2017 there was 75% relief. Mortgage interest relief begins to be phased out. 2018 there was 50% relief, so that's a reduction of a third. Tax burden rises for higher rate taxpayers. 2019 there was 25% relief, so very little relief now. Many report losses despite positive cash flow. And 2020 there's 0% relief, so that's the full Section 24 effect, tax on gross rent. The impact is an extra tax of £2,000 plus per property per year for higher rate taxpayers. Portfolio landlords have been hit hardest. How the tax calculation changed. Section 24 fundamentally changed how rental income is taxed. The shift from full interest deduction to a basic rate credit dramatically increases the tax burden. Before 2017, rental income £24,000 typically, less mortgage interest minus £10,000. Taxable income was £14,000. Taxed at 40% is £5,600. So your net income from £24,000 after tax is £18,400. Full mortgage interest deducted before tax is calculated. But moving forward to after 2020, on the same rental income, £24,000, it's taxed at 40% on the full rent, £9,600, less 20% credit on interest, £2,000. The final tax bill is £7,600. So the net amount after tax is £16,400. There's an extra tax of £2,000 per annum. The tax trap explained. HMRC taxes you on full rental income, not profit. Your mortgage interest is no longer deducted before calculating tax. Your rental income is fully taxed at your marginal rate, 40% or 45%. Mortgage interest is only 20% basic rate credit returned. So the gap is you lose 20 pence in every pound of mortgage interest. This compounds every year you hold without a strategy. A worked example, a typical higher rate taxpayer with a single buy-to-let property with a rental income of £24,000 per annum, mortgage £200,000 at 5% is £10,000 interest per annum. Tax rate, 40% higher rate taxpayer. These figures form the basis of our before and after Section 24 tax comparison on the next slides. So before Section 24, full mortgage interest deducted before tax is calculated. Rental income £24,000, less mortgage interest £10,000, taxable income £14,000, tax at 40% at £5,600, net after tax is £18,400. You kept £18,400 of your £24,000 rental income. After Section 24, mortgage interest is no longer deductible, only a 20% tax credit.